Welcome back. As we've grown the program, we've expanded it to include topics of designing, developing, and starting a hotel. Almost since the beginning, Dan Lesser has been just great in his time, energy, and ideas, and also with Michael Blank coming in. We'll talk about both of your careers and how you do your work and your market segments. But if you don't mind just introducing yourself, would be great. Dan, why don't you start first?
Sure. I'm Daniel Lesser. I'm President and CEO of LW Hospitality Advisors. And thank you for having me.
Great. Do you want to talk about the university at the corner of Lexington Avenue?
If you'd like me to.
I would.
So, Steve doesn't forget that. One of the first times that he heard me give my biographical background, I mentioned that along the way I did 2 years at City University of New York at a university called UCLA, University on the corner of Lexington Avenue, also known as Baruch College. So that's UCLA.
Great. And then also you went to, I mean, briefly though, you went to EHL in Lausanne and then also Cornell?
That's correct. So I started out at Baruch College, UCLA. I then went to the École Hôtelière in Lausanne. I was there for a year after 2 years at Baruch College. And then I transferred and ultimately graduated from Cornell University School of Hotel Administration.
Right. And were you ever in operations before, during your career?
Yes. So while I was going to school, I worked in several hotels, including the New York Hilton Hotel on 6th Avenue and 53rd Street in Manhattan. And then upon graduation, I worked full-time at the New York Hilton Hotel for about 2.5 years. And between both stints, it was a little over 3 years. I worked in every sub-department within the front office and every sub-department within the food and beverage division. Keep in mind, this is a 2,000-room hotel, an amazing learning laboratory to really understand hotel and learn hotel operations. After finishing both of those programs, I ultimately got promoted up to the catering sales office, and that's where I finished my operational career.
Excellent, thanks. Michael, thanks for joining us. Your work at Cornell, and then I believe you were at the Willard for a while.
Yeah, thanks for having me. I actually grew up near the real UCLA in Westwood and moved east for college. I went to Cornell for hotel school and then moved down to DC where I worked at the Willard. And ironically, I finished my ops career in catering and sales as well. I realized I wanted to jump outside of the operations side of the business. So still in DC, been here longer than I care to share, but always doing different things.
Great. Dan, LWHA, what is it? And then part of what it is leads us into our conversation on asset management and advising the parties.
So LW Hospitality Advisors is a hotel-centric real estate and operational services firm. All we work on are lodging assets, hotels, resorts, casino, conference centers, timeshare properties. We have 35 professionals that are domiciled throughout the nation, including New York, Atlanta, Cleveland, Minneapolis, Austin, Texas, Seattle, and San Diego. And we've been in existence about 9.5 years. We've provided services during that time in all 50 states, Canada, Mexico, the Caribbean, and the United Kingdom. During the course of my career, I've actually done work throughout the world, including in Asia and the Middle East. So we have 3 main buckets of business, LW Hospitality. The first bucket I characterize as non-advocacy work. And let's call that appraisal, valuation, market study, feasibility study, litigation work. This is expert work that, irrespective of whoever may be hiring us, right, to do an appraisal, it could be a lender, it could be a sponsor. Our conclusions are either, it doesn't matter who hires us, they're within a reasonable range. So that really is our core competency, and that is, you know, what I'm known for the 40 years I've been doing what I do. So that's bucket number one. Bucket number two is asset management. We actually refer to it as asset management and development consulting work. We have been very fortunate to carve out a niche with folks who we very respectfully refer to as newbies to the hotel space. So these are smart, sophisticated folks who know and understand real estate. They know and understand their markets, finance. They either have money or access to money. They get involved in a hotel for the first time, never having been involved in one previously, and one of two things happens. There are many who initially approach hotels as, well, it's just another food group of commercial real estate. And they quickly find out, typically after making some sort of a mistake, that's not the case. They're very unique forms of real estate. They're going business concerns that are married up with bricks and mortar. Very complicated businesses, no credit tenancies, daily leasing of guest rooms, with technology being what it is. Pricing of those rooms literally changes by the nanosecond. If you think of a full service hotel or a resort hotel, there's varied revenue streams coming in from heads and beds, obviously, which is rooms revenue, but then food and beverage, recreational revenues, retail revenues. Those are all very, very different sources of income. And of course, the expenses associated with those different revenue streams is quite different. So the bottom line is that the hotel business is a very, very complicated business, again, married up with bricks and mortar real estate, high fixed costs, high labor costs. It's a challenging business. So the folks that invariably, you know, make a mistake signing an LOI or maybe a management agreement that is somewhat onerous, and somehow they find us and we find them with the plea of, you know, can you help us undo this mistake and or mitigate any sort of damage associated with it. The other group that either finds us or we find them is you know, those who know what they know and those who know what they don't know. So the newbies who get into the space and realize everything I just described, you know, we do a lot of work with these folks. So it's asset management and development consulting. We have a portfolio of about 15 hotels that we asset manage. Traditional asset management. I'm one of those folks who believes that if you ask 10 people to define asset management, you'll get 11 different definitions. But with that being said, we oversee day-to-day operators. We are not day-to-day operators. So that silo, if you will, the second silo that I'm describing, the asset management and development consulting, is advocacy work, as opposed to the first silo, which was non-advocacy work, right? We're advocating for our clients in the second silo. And then the third silo is something that we just, a platform that we just announced a couple of weeks ago. Great timing, right before COVID we did it. It's going to be a home run. It'll just take a little bit longer. So a gentleman by the name of Ryan Meilicher, Michael, you may know him, fairly well-known Wall Street stock analyst focused exclusively on the lodging space. His last stint was director of investor relations and strategy at RLJ Lodging. And Ryan approached a point in his career where he wanted to start his own analytics platform and wanted to leverage off of a brand name, if you will. And so he interviewed several folks, and you know, we were fortunate that he selected us. And so we actually announced this analytics platform a couple of weeks ago. We're going to be rolling out beginning of June with a deck of 25 in-depth analytical reports that look back and forward for the top 25 markets. The beauty about what Ryan has put together is that it's, number one, information that we have never seen put together elsewhere, and number two, his forecasts. he's able to sort of look back at his prior forecasts to see how close he was or not, and he's got an amazing track record. He's very spot on with his projections. So we're very excited about this new platform that we're rolling out as we speak.
And you also, in the past, I thought, put out monthly newsletters, quarterly reports. What silo does that go in?
Well, actually, all the silos. I think you may be referring to my quarterly report on major sales within the United States, and it's something I've been doing for I think since 1991 on a quarterly basis. I track major single asset sales in America, 10 million or more, but not part of a portfolio. Because in my mind, if you look at what I just described, and it was in the open market, willing buyer, willing seller, nobody under duress, it represents true market value. When you're looking at portfolios and then allocated purchase prices within portfolios, you never know what's behind the allocation. Right. So the survey that I put together is just single asset trades. And yes, it's a survey and an analysis of what's going on in the market and what we're seeing going forward.
A few quick questions before we get to Michael, maybe in reverse order. We've talked in these sessions about the STAR report, other fundamental sources of information. Michael will talk about what he uses, but to me, it feels like that quarterly report is awfully important in the marketplace. Maybe it's not a question, but a comment.
Which report?
Your quarterly
Thank
report.
you. Thank you. I'm very blessed. Again, it's something I've been doing since 1991, so for 30 years, I can't begin to tell you that as we approach the end of every quarter or shortly after the end of the quarter, my email box always lights up. Where's the report? Where's the report? So yes, you're right, and I consider myself very fortunate that the content that I'm putting out is relevant and folks are interested in it. I will tell you, I've always been very deliberate about the content I put out. Let's face it, there's an awful lot of material that is out there in the world. It's overwhelming, and I'm a firm believer of imparting knowledge, intelligence, opinions, as opposed to talking about myself. I mean, I don't think really people are interested in hearing about me. They want to hear about what's going on in the market and what do I see. And so thank you for the compliment.
Many years ago, it's just a quick question, but many years ago, you talked about ego owners who just took pride in having hotels. I'm not, embedded in the industry like you and Michael. Are they still out there, or is it fewer and fewer of what you described as ego owners?
There is always an element of ego ownership in the lodging sector. As long as I've been doing this, again, 40 years. And I think if you look back, to the early days of Las Vegas, when Las Vegas was getting developed, right? A lot of those folks that were involved in those initial developments, sure, they were looking to make money, but there is something about the hotel business and hotel ownership and hotel investment that forever has been perceived as sexy, if you will, right? Listen, if you own a couple of strip shopping centers and let's say you're getting a 90% return on your money, which is a grand slam, right? You're not going to really go around and brag to your friends about, oh yeah, I own those strip shopping centers, right? But I have encountered many ego investors over the years who own gorgeous, trophy, irreplaceable assets that lose money. And guys love to brag to their friends about, I own that place. Come hang out with me at my place. So there are always an element of those types of folks. I wouldn't say it's predominant by any means,
right.
But it does happen and has happened to me on a routine basis, sitting down with somebody new, getting to know what their objectives are. And the first thing that comes out is, I want to own this place. And then I say, well, what about making money? Oh yeah, I want to make money too. So.
Okay. 2 questions and we'll circle back with you later on them, but I'll jump with Michael. Social media, I know you, obviously I like you and I pay attention, but I think your social media presence is effective. We'll come back. And then, look, these are students who are going to be having careers and making decisions. Both you and Michael made leaps, which we'll come back to your leap of starting LW Hospitality Advisors. And we'll go to Michael making a leap from a comfortable position at RLJ to Woodmont. But we'll circle back to those. Michael, do you want to start with RLJ and then that leap and what Woodmont Lodging is?
Sure. So I was at RLJ for about 6 years.
You might want to describe what RLJ is, sorry.
RLJ is a publicly traded lodging REIT. So it's a owner of REITs. They own today, I think, around 80 to 90 hotels around the country. They were originally a private fund that was started by the gentleman who started BET, a guy named Robert Johnson, who took his money and invested in the concept of investing in hotels. Started out with 5 or 6 hotels from Hilton and grew that through 3 funds, and then ultimately went public. You know, I joined RLJ when they were private still in acquisitions and on their 3rd fund, and saw that through to going public. I have a background in public markets research, so that's how I knew Melliker from back in the day, actually, and took that experience and translated it into overseeing their data analytics platform and asset management to help RLJ transition from a private company that only reported to a few investors to a public company that reported to a lot of investors on a very consistent basis. So I was there, you know, through private to public to reporting. And then 5 years ago, a colleague and I decided to do it for ourselves, where we left RLJ and decided to invest in primarily select service, but focused, you know, small full service hotels, focused in secondary, tertiary markets. So we left 5 years ago. We have 7 hotels today, 3 in North Carolina, 1 in Virginia, 2 in Arkansas, and 1 in Pittsburgh, PA. You know, describing what we do, probably 75% of our time is investment analysis, investment acquisitions work. And then 25% of our time is advisory work because we have the bandwidth to do it. So we do a little bit of asset management. We also talk to other owners to just help them on a case-by-case basis with new development, negotiating with the brands, whatever it is. Just given my experience in the hotel industry and my partners from a capital market side, you know, we provide some of that context or color to those individuals who decide they want to get their toes wet in this industry, even though they may not have any experience in it. So we're just, so we've been fortunate to have kind of been busy on both buckets, and you know, are continuing looking to grow is our primary focus.
Great. What's a secondary or tertiary market? Either one, but start with Michael.
So think of it as anything smaller than the top 25 MSA, generally, you know, examples of markets that we're in. So Winston-Salem, North Carolina, Northwest Arkansas, Bentonville, even Pittsburgh is still not a top 25 market. So for us, we aren't the biggest capital funded. We're not going to be able to compete with well-capitalized individuals or high ego driven individuals that want that trophy asset in New York or DC. And so we've been able to kind of cultivate our own, you know, strategy to find opportunities where others may not be looking.
And the leap from RLJ to Woodmont Lodging, Mrs. Blank, was she okay with the move?
She was. I mean, you listen, I guess I gave her exposure by, you know, losing my job in the last downturn. So, you know, we figured we could survive a year almost without a job and kind of bootstrapping it. And this was no different.
Great. In classes that Michael's joined me in classes in the past, you've talked at length, and we don't have the time, unfortunately, but doing that first deal was hard. Getting your equity in line, and it just took more. I think your story was it took longer and harder than you ever expected. Do I have it kind of right? And I'm sure, Dan, you have stories about the same.
Yeah, you know, listen, working in institutional sized companies doesn't prepare you for the risks you have to take with little backstop behind you and what's required to get a deal done, whether that's how you're going to pay for attorney fees or even how do you come up with the money for a deposit on a hotel. So those, it was a very painful but necessary learning experience to get that first deal done.
Dan, any thoughts on characteristics of good, strong owners? Are they dogged? Are they creative? Or they're just all over the place?
Well, I've been involved in a number of principal transactions over the years as well, and I like Michael's point a moment ago about sort of safety of large corporations. So I grew up with parents that were refugees from World War II and came here with nothing. I grew up in an apartment building. First house I ever lived in was the first house I bought. And so with that as a backdrop, I was always, I was really far from an academic genius, but always very street smart, and figured out how to make money at a fairly young age, just intuitively, instinctively, if you will. I was 14 years old and I was raking leaves and mowing lawns around where I lived. And it was sort of backbreaking work. And I had friends that I would hang out afterwards on the basketball court shooting hoops. And then one day it dawned on me, like, you guys are a bunch of degenerates. You should come work with me. And I got to the point where I had two crews and they were doing all the work. I was collecting the money, paying them, making the arbitrage. And fast forward, 5, 6, 7 years later, my first finance class where I learned the concept of financial leverage, I was like, oh my God, I know what that is.
Right.
So with that as a backdrop, and then I worked after Hilton. I was the first hire of Steve Rushmore when he founded what was then Hospitality Valuation Services. Today it's known as HVS. And I spent 13 years, very entrepreneurial, working with Steve and building that practice. And then I did 15 plus years between Cushman & Wakefield and CB Richard Ellis, which are corporate backdrops, but very entrepreneurial. So, the notion of finding that first down payment, the notion of, where's this going to come from? I mean, that's really been my whole life. And so I totally resonate with that sort of mentality. And, I'm a big believer in, I consider myself very fortunate from really starting at the bottom, right? When I graduated Cornell and started with Hilton in the food and beverage program, my first week, they had me run the beverage storeroom for the guy who ran it for 30 years, who was going on vacation. I showed up there one day and they're like, go hang out with Mo for a day, learn how to do it. So the point being that, scrappy is kind of what I know about.
Great. Let's move over to, I'll pull up the whiteboard, I hope. I got it. Are you guys seeing my whiteboard?
Yes.
So hold on, I need to get to the right place. Hold on. All right, I'm good now. We're going to go to your second silo, Dan and Michael, your work. We're going to either buy or develop a hotel. Dan, let's start with you, just in the basics, raw land. How often are you dealing with raw land being either a building comes down or it's a piece of land, owner has a vision, owner is going to design, develop, and construct a hotel, including zoning? Does that happen ever, often?
So it happens quite often. I would like to, though, clarify, in my mind, raw land is just that. It's raw land.
Okay.
Which means that it doesn't have utilities to the site.
Okay.
So I would say that, for me, more often than not, I'm dealing with land, but that is already improved with utilities.
Sure.
Okay.
That's fine. And as a matter of backup.
By the way, I have also worked on lots of developments in the Southwest that were very large mixed-use developments that originated as raw land and part of the entire development of a residential, hotel, retail, office, mixed-use complex, a transient hotel was proposed as part of it. So anyway.
Sure. No, I mean, it's a fair distinction, and given the time, but let's say it has utilities, but let's say there's some not clear zoning as part of this raw land or land.
So there's a concept called highest and best use.
Okay.
And that's really what needs to be done for any sort of analysis vis-a-vis either raw land or vacant land, vacant improved land.
Sure.
So the first question is, you're looking at a piece of dirt, and what needs to be answered is, what is physically possible on this site, right? Depending upon how the site is configured, its actual size. So can you physically put on a hotel, an apartment building, and all? What are the various uses that are physically possible? The next step, if you will, is, so you have this pool that you've come up with, a physically possible. The next step is legally permissible, right? So that's zoning, right? What you take that first answer and you go to, okay, what is allowed by zoning? And you filter it down. Or maybe all those uses are allowed by zoning, or maybe it's raw land and you're doing a planned unit development where there is no zoning, but you're creating the zoning as you're doing the planned unit development, right?
Okay.
But let's say initially it's apartment, office, hotel, and retail, but residential is apartments are legally not allowed. All the other uses are. So you go down to that step of what's legally permissible, right?
Yes.
Office, hotel, retail, because residential is not. Then the next question is, what is economically viable out of those leftovers, right?
Okay.
You run an economic analysis, profit loss, frankly, projections, and return analyses for those remaining premises, office, hotel, retail. That is economically, what did I call that? Legally permissible, economically feasible, right?
Okay.
And then the last test is maximally productive, right? So you have these three forecasts and return analyses, and you analyze the three to determine which one of these three produces the maximum level of profitability and return. And that is what ultimately is going to get someone to, deciding what to build, and then once the property type is determined, configuring the specifics of it.
Okay, so let's just go back for one moment. We've talked in various sessions about the pro forma. It's come up. I've described it as both a budget and a forecast. Should be fairly educated. I mean, the budget should be somewhat knowable. The forecast is what you're paid for and your experience. The cost of the land is knowable. The cost of construction will be within a plus or minus. How are you doing forecast and both Michael and Dan, how are you doing forecast for market demand? Are you looking at convention centers that are being built, a baseball team that's coming to town, new highway being built? What are you doing to understand that driver?
Michael, you take it.
Michael, go ahead.
I mean, obviously, you kind of touched upon a variety of different locations, right? So urban setting, you're going to look at your conventions, your compression demand generators that are what's driving business to the hotel, to the market. You're going to look at major companies, take DC with Amazon coming, all of a sudden that becomes a factor in your math of demand, both for the specific location and then the region broadly.
Okay.
If you're looking more outside of an urban setting like we do, we're looking at things like universities. So how much business does the university produce for the city in terms of graduation weekend and, parents weekend and those type of events, sporting events. Traffic counts can be critical. So, if you're a highway setting and you have a certain product that really is driven toward that kind of business, you need to make sure you're visible and near a highly trafficked, highway or city or street.
Okay.
And then we're taking, for us, we look at kind of macroeconomic data. So what's household income? What's, if it's available, GDP growth for the city or the MSA, and both looking backwards and forwards to say, okay, how has this city or MSA grown, and how stable is it, and what's its outlook, and how much of that will factor into growth and demand for the hotel and for the market overall.
Great. Dan, anything else on market analysis?
I think we covered it.
Okay. I know I'm jumping around, but we'll continue to jump around. I postured it with raw land, and then we revised it with land with utilities. It could be, I'm doing a new thing, adaptive reuse. Dan, do you ever deal with that? Taking a library or a church and making it into a hotel.
All the time.
Okay. What would be an example? Or would a church to hotel be a good enough example?
I've worked on church to hotel. I've worked on railroad station to hotel. I'm drawing a blank all of a sudden.
Office buildings are typical.
Office buildings to hotel.
The floor plates.
Absolutely.
Okay.
Now keep in mind, I've also been involved in assets that I haven't done the study because hotels are my expertise, but I have worked on assets that were converted from hotel to other uses.
Sure.
Okay. Resi to hotel, residential to hotel.
Okay. So the analysis that we talked about is going to hold true no matter, and we'll have some more, but you're still going to do feasibility. What's it going to cost to construct? What's the market demand? That's going to hold true across these types of development.
Yes.
Okay. Michael, your work, well, I'll ask you, but your work seems to be taking select service that may be underperforming, and the term I'm trying to reach for is reposition. You can't reposition land, but you can reposition a hotel, add value. Tell us about your work and what I'm trying to fumble at right now.
Listen, so, out of the gate, we were focused on taking a box that may be great, well located, but is just undermanaged, and applying, the skills that we've developed over the years and trying to identify where we can extract more value in the operating business, right? So because it's a daily lease model, hotels are, one of the few real estate opportunities where you can see overnight improvements to your operation. Conversely, you can see degradation at just as quickly, but we focused on finding opportunities where the hotel is undermanaged, and we bring in, institutional management and our institutional oversight and identify where we can, squeeze more juice from the lemon. But, as we've kind of grown and matured, we're also looking at a variety of different opportunities. So, we're looking at, the conversion type opportunities. We looked at an office building to conversion, and frankly, right now, we're looking at a hotel conversion to apartments. It's not what we do, but we know people that do that, and so we're partnering our skills of hotel people to identify where we can find good hotels with good bones and good markets, and partner with those who know how to take a building and turn it into a residential complex. So, the beauty of hotels is there's a lot of optionality with the physical structure. And so we evaluate hotels now for both, ongoing operation, a value add of the existing asset to remain a hotel, or, you know, an alternative use.
So
You know,
Dan,
I'd like to just add, if you don't mind, is it okay if I just add something?
yeah, of course.
You know, I firmly believe that any hotel investment, not going hotel to another use, but every hotel investment is really a value add proposition play, right? Anybody who's looking to buy an annuity and steady income in the
Right.
form of rents, you're not buying a hotel. You're buying multifamily, you're buying office building, retail, what have you. You know, I just think it's important to recognize that the hotel space is all about, you know, value enhancement opportunities. Again, nobody buys an asset saying, oh, okay, it's got this in-place income and it'll just continue along. That's not what the sector's all about. Anyway,
Right. So if your client has an office building and Microsoft leases 90% of your office building, there's not a whole lot of drama going on, probably. That
No.
would be more like an annuity.
You're buying a fairly steady income stream with a credit-backed tenant, which is a complete opposite of a hotel.
Okay.
Daily leasing with no credit tenancies.
One more to add. I mean, there are many more to add, but one more to add. Michael was talking, I think, about subtly improving a hotel. Poorly managed, better managed. Maybe it's got dated carpet and it just looks old and you freshen it up. We also talked about adaptive reuse. Maybe start with Dan. You might have in New York, Chicago, anywhere, a terrific location and just a beaten up property, and you want to convert it from, I don't know, a C to an A or a trophy hotel. I assume you deal with that often, Dan?
Yes.
Tell us about, do you have an example city? I mean, there's a Cambria in Chicago. I don't know. What would you have in mind?
So, I mean, I've looked at opportunities where, I mean, Chicago, I remember a long time ago looking at a high-rise Days Inn in downtown Chicago that ultimately, if I recall correctly, was converted to a W hotel. This is back in the Starwood Capital days.
Okay.
You don't see that as often, right? Going from a brand that's perceived as at this level up to you know, branding that's dramatically higher. More often than not, you see it as, okay, well, the asset is sort of at the end of its economic life as a Hilton, and you know, the next generation of its evolution is becoming a DoubleTree. Right. Not that, you know, this one is better than the other. There are different price points and different target markets. Did I answer the question? I'm not sure.
You did. And on the project where you take a Days Inn to a W hotel, to me, it's almost feels like an adaptive reuse in a way. I mean, you're going to be spending a lot of money on improving the elevators, maybe busting through some floors for an indoor spa or something of the sort. It's not just going to be carpet, paint, and a new lobby to go from a Days Inn to a W hotel.
Absolutely. I mean, I've seen high-rise Motel 6s in suburban Los Angeles, you know, getting converted to Courtyard by Marriott's, right? And then I've seen old Courtyard by Marriott's being converted to Days Inns. So I mean, it goes both ways.
Sure.
And again, it's
I
a
think
highest and best use analysis.
See, I think you should think of it as like two life cycles that kind of overlap, right? So
Sure.
hotels typically, right, they get built as something class A and they degrade over time. Depending on where it's located, where there's no, vacant land, right? The only option becomes, revitalization of well-located assets that may have degraded over time. So, so you'll see a lot of hotels that just, degrade from a tier 1 brand down the chain scale till it's just not a viable asset anymore. But
we've talked about this. I'm sorry, we talked about this in
opposite.
Go ahead, Michael.
And just in big cities, you'll see hotels like this Days Inn, right? And I think the Four Seasons in Georgetown was once a Holiday Inn, right? You know, well-located assets will be spared, you know, death sentence at the end of the day.
You know, as Michael's speaking, I'm thinking of in Palm Springs at the southern end of downtown, just as you exit downtown Palm Springs, there is an old two-story motel that in its heyday was a Howard Johnson's. Exterior corridors, two-story. Today is the Ace Hotel in Palm Springs. It's remarkable what they've been able to do with this, frankly, physically and functionally obsolete asset, and the way they've been able to, you know, rejuvenate it into this hip and cool facility.
We don't have the time, obviously, but zoning is a huge issue in any real estate development. If you've already got a building that's zoned for a hotel, you've just solved lots of problems. Dan, or Michael, in many sessions or some sessions, we've talked about the extraordinary wear and tear on a hotel. Can you just, I mean, a hotel is going to decline if you don't do anything. I mean, it's a natural to go from, you know, one asset class to another. You want to just talk about it for a second, the upkeep that's needed?
Michael, I'm going to let you take that one.
Yeah, Michael, go ahead.
Yeah, I mean, you know, it's like when you take a new car off the lot, right? It degrades from day one. And, you know, the hotel brands, if you franchise, whatever, will make you maintain a certain standard of quality. But yeah, it's a capital intensive investment. Not only do you have no visibility of your cash flows, you are guaranteed to know what your outflows are at some point in time. So yeah, there is you know, the standard rule of thumb is that you are doing a renovation of some scale every 6 to 7 years. And depending on the age of the hotel, that renovation grows exponentially in dollar and scope. And then there's just the ongoing maintenance, you know, carpet, beds, you know, TVs, whatever it might be on a regular basis.
Great. Michael, where my cursor is, your Woodmont Lodging is working in this reposition value add, taking secondary, tertiary markets and making them better and driving up your rate and occupancy. Is that your sandbox?
That's pretty much where we focus. We're dipping our toes in development now, but for the most part, for the last 5 years, it's really buying, you know, existing assets and updating them.
Great. Okay. Any other topics in this area of types of land, I suppose, or building? Dan, let's start with you. We have a session on architecture and design, but when are you thinking about, is this going to be a luxury property? Is it going to be mid-scale, boutique, select service? When do you start identifying what it's going to be, this hotel? You've gone from retail, office, it's going to be a hotel.
Well, I think once you get to economic feasibility, which is that third step of the highest and best use analysis,
Right.
Whatever's left in that bucket, you need to start looking at for each category, whether it's resi, retail, or hotel. You need to look at different levels of fit and finish and final product, if you will, and comparing it to construction costs. So that's a long-winded answer in saying that really when you're looking at the economic feasibility of development is when you're drilling down to what type of hotel.
And what's going to inform your decision about, whether it's going to be a luxury Four Seasons or it's going to be a JW or I don't know, or a DoubleTree.
So Michael spoke about this in terms of you know, understanding sort of local demand generators, right? The hotel business, you know, is a global business, obviously a national business, But ultimately, from a day-to-day operational perspective, it's a street corner business. And so depending upon where a particular site is, and determining what the highest and best use is, whether it's a luxury hotel or a select service hotel, is really, drawing a circle as a radius for a trade area, right? And then thoroughly understanding the economic and demographic drivers and generators within that trade area that are going to feed demand into a hotel. And when I say feed demand, I'm not talking about just rooms. I'm talking about catering, restaurant, bar, leisure activities, et cetera, et cetera. So you're going to start looking at it again at the third stage of highest and best use, which is economic feasibility of whatever property types are in that bucket, and then going from there.
Michael, how do you regard asset class, or is it similar?
Yeah, I mean, I don't generally look at kind of luxury and that. I really look more at the nuance between brands and I guess the types of products. So, whether the market needs, a restaurant, or is there a bar scene that you could generate business? Is this really more of what they call extended stay type hotel, where you have almost more of a residential type feel, because that's really the type of business that's out there? Or, one of your more traditional boxes? And then what brands or what type of products are even available within that sub-market or market to choose from?
I would add too that you also need to look within the market area that you're observing. What is the availability of land? What is the availability of development, right? I think it's safe to say that if you're looking in a market where land is scarce and you have very high per foot value, right, and you have high barriers to entry vis-a-vis development, it's probably going to lend itself towards more of a luxury orientation. Again, irrespective of whether it's retail, multifamily, or hotel, right? It's going to probably orient more towards luxury as opposed to any of those property types in suburban Tucson, where you can buy land for next to nothing, right?
Sort of time and again in the program and in general, Marriott or whoever executive would say, given a choice, I would just buy or run a Courtyard and make my money and go home. Is there any connection between luxury brand and making money? How do you think about the economics? Is there more opportunity at a luxury brand for that volatility to drive revenue, ultimate revenue? Dan?
I don't know if this call is being recorded, so I have to be careful what I say.
I can pause it. No, I can't.
I think it's hard to generalize.
Sure, of course. Okay, that's fine. Michael, any other comments? I mean, I know you like this area, and you can make money if you can charge an extra $10 and get a little bit more occupancy, you've done well with your property.
You just have to remember that, with higher service comes higher cost. So there's not a 1-to-1 ratio of charging $10 and getting $10 to the profit. In general, higher serviced hotels have lower operating margins broadly. Obviously case by case changes, but full service hotels operating margins are generally lower than select service, and luxury is comparable. So it doesn't mean you can't make a lot of money. It just means that margin wise, they're thinner margins than lower service hotels.
And I think, Michael, when you talk about margins, I believe you're alluding to sort of percentage of profits of gross, right? But another way to look at it is on per available room profits. And you could have a select service hotel that from a ratio perspective has a much higher profit margin, and a luxury hotel that might have a much lower profit margin from a percentage perspective, but on a dollars per available room is much higher than the select service.
Yeah, that's true.
Yeah.
Great. As a side note only, and we talk about it more in the design session, but when we were growing up, the three of us, or at least when I did, hotel F&B was dreadful. I mean, you just wouldn't think about it unless you were just starving. I mean, the last 15 years, it feels exciting. Drawing in the neighbors to the edgy bar, interesting dining. Dan, do you agree? Do I have it about right?
You do have it about right, but it needs to be done extremely carefully, extremely carefully. Yes, you are right. Back in the old days, when I started, you know, the notion of a restaurant and a Holiday Inn, it was like, you're right. It was, if I was about to eat cardboard, I would go there first. You know, today that's not the case. Food and beverage has become a lot more of a thing. And within the hotel sector, you know, for the most part, the industry has figured out, you know, how to deal with a revenue stream that is, I mean, let's face it, it's a restaurant, right? Food and beverage, it's a tough way to make money. And hoteliers were traditionally very good at putting heads in beds, but not good restaurateurs. And so that's when we, you know, started to see, you know, food and beverage folks sort of come into the hotel space because the smart, sophisticated investors within lodging were saying, listen, let's stick with our knitting, right, and let the food and beverage guys deal with the restaurant side of the equation. And, you know, all sorts of models have been developed, from, you know, bringing in a celebrity chef, you know, as an employee to a management contract with a food and beverage operator, to an outright lease to a food and beverage operator. In terms of working out economic structures that end up being profitable for both parties, if you will. But yeah, hotel food and beverage has definitely come a long way. I don't know if you mentioned rooftop, you know.
Oh yeah, that's every conversation is rooftop bar.
Correct. So, I mean, listen, there's money to be made. There's no question about it. And in terms of, you know, beverage, there's a ton of money to be made. So, yeah, I mean, I've looked at many hotels that actually had food and beverage revenues that were equal to or exceeded the amount of rooms revenue.
Which was unheard of 15 years ago in general.
Correct.
Michael, are you looking mostly at the waffles and breakfast buffets, or are you paying attention in your hotels to
Buffets are over, Steve.
What's that?
Buffets are over post-COVID.
What we used to think about as buffets for breakfast.
Yeah, I mean, listen, predominant of the hotels we own are just really focused on that complimentary breakfast or reception. You know, but we asset manage, you know, full service hotels, and we focus a lot on that food and beverage component. And we own a hotel that does 60% of its revenue is from catered events and restaurant business. So we focus a lot on how to squeeze more of the dollar to profitability, but it's not easy. I mean, we were working for a client that had a very successful restaurant, a very well-regarded chef, but, you know, a profit margin of 5 to 7%, right? And from the management company standpoint, they saw it as the cachet that the chef brought to the hotel. As a owner's advisor, I saw the profitability that wasn't being delivered. And so it's, you know, it's interesting to have that dynamic of how do you define success in food and beverage, and how do you translate it to the whole operation.
Great. We're going to try to probably blend a few thoughts. We have sessions on, before I go there, we're going to have in the contract drafting section, we're going to have a chef agreement, because I think it's an interesting agreement that has a lot of drafting in it. We had sessions on hotel lending. We had sessions on equity. The topic here is brand or no brand. Michael, do you want to take the first crack? Would you look at a property without a brand? Be independent of sorts?
I think, this question is, a lot of it's driven by the means in which you can afford to build a hotel or buy a hotel. For us, we would never look at a hotel that's not branded or generally continue to keep it unbranded, because what we found is that the lending environment puts higher hurdles to buy a hotel or less debt to get the hotel because of the perceived risk of not having a brand on it. So for us, our first gut instinct is to always look at a branding option, one form or another, at every hotel that we look at. But that is really driven by the lender's need for it, and even our investors have come to expect the value of having a brand on a hotel. So, we generally consider branding as the only option.
Right, and I wrote down, excuse me, reservations, customer loyalty, lenders. I mean, presumably the lenders are demanding it, and are Hilton and Marriott and Choice and Hyatt delivering on reservations and customer loyalty for you, Michael? Or whoever your brand franchisor is?
Generally, yes. I mean, there's obviously a pretty high cost with that.
Sure.
I just to add to the lender part, the lenders, in my view, right, they look at these loans with risk in mind, at the top of mind. And if they have to take over the hotel for whatever reason, they want to have the comfort that at least they know that the Marriott flag or a Hilton flag or Choice flag is creating some value for the asset that they now are stuck with, because of the reservation system, because of the customer loyalty, because of the brand consistency. Those things give them comfort that that the hotel will have its value sustained, and that's so that's very similar point of view that we have, which is that Hilton and Marriott and the other ones, to a lesser extent, really help drive value for the hotels.
All right, I think I just messed up. Okay, Dan, any other comments on, or what are your thoughts on behalf of your clients?
Well, I think I would add, I think the space that Michael plays in, Michael, is it fair to say that you're not typically within the top 25 in the downtown core? That's fair. Right. So for where Michael plays, I would agree 100%. It's probably more towards brand as opposed to no brand. But when you start getting into the inner urban 24/7 downtown markets, again, it comes down to economics, right? Are you getting more bang for your buck with a brand versus without a brand? And let's face it, every urban market in America has its fair share of independent hotels that do just fine, and frankly, from an economic perspective, may do better than with a brand, right? And so you really kind of need to look at where the asset is located. Another way a lender looks at an independent hotel in a downtown urban core is that it might be beneficial, particularly if the economics are better, running as an independent versus branded. But the notion of, if I have to take it back one day, I can brand it, right? And then I can decide what the best optimal brand is, as opposed to inheriting the asset with a brand that may not be actually the appropriate brand for the product. So that notion sort of cuts both ways.
Okay. Do you have clients so you have clients with hotels that are independent?
Oh, for sure.
Okay.
Absolutely.
And we have separate sessions, but do they do their own reservations and customer loyalty, or will they go into a vendor for reservations? It's everywhere.
I know of a group in New York that shall remain nameless that
Sure.
has a collection of assets, frankly, within the 5 boroughs. Every single one of them is independent, and I don't believe if you slap some sort of brand on it, it would do any better. Probably from a bottom line perspective, it would do worse. So yeah, I mean, again, it really depends on where it is and what it is. These folks, they might. I don't think they have. I think they work on their own reservation platforms, their own identities for each property, and then online travel agents.
Sure. We have sessions on that as well.
Don't forget too that there is always a big question about, you got the big brand name on it, right? But if you're also relying upon online travel agent bookings, right, as an owner, you're paying everybody. You're paying the OTA and you're paying the hotel company, right? So you got to think about that too.
Right. Great. So I was going to leave this topic and head to your work as asset management, or what I think of as asset management. The hotel's been open a couple years. It's somewhat stabilized. It's established. Both Michael and Dan represent the hotel owners. And maybe you're not feeling like it's operating at 100%. What roles are you playing to understand how the hotel is doing, and then what action do you take, Michael, as asset manager?
If
I have it right, even.
I mean, my personal opinion is I find that hotel operators sometimes get pretty myopic with how things are done. And so for us, it's really to provide a perspective of the outlook or the operation that maybe the operators haven't thought about, or, I'd say, or refuse to think about. So, many times it depends on how the agreement is structured, right? There are arm's length agreements. We can't dictate, changes in headcount or changes in strategy for rates. But we have a lot of influence. So whether it's, having the management try to push rate, or take a different revenue management strategy, changing the way they operate, changing in terms of headcounts or service, we're going to push the management teams or whoever's operating the hotel, and a lot of times the directions they're not comfortable with, to try to find ways to add value to the operation.
Great. Dan, your work in a similar area on behalf of your hotel owner clients?
So, again, I've never met a hotel owner and or operator who didn't think they could do better than the prior regime. It's sort of the name of the game in the hotel space. It's, from a broker perspective, what are hotel brokers selling? They're selling the dream, right? Here's this box today, and here's what you can do with it, whatever it may be, right? Here are the value enhancement opportunities, and I like what Michael said, squeezing more juice out of the lemon. You mentioned stabilized. I firmly believe that there's no such thing as a stabilized hotel.
Okay.
Again, mostly due in part to the fact that you do have this daily leasing, right? With pricing of room rates changing by the nanosecond. And in an up market, that's a beautiful thing. In a down market, it can kill you. And the hotel business is so dynamic, right? When you look at a trade area, like I talked about before, invariably there are, existing demand generators in the market that are growing or declining, or maybe moving out of the market, right? Maybe there are new demand generators moving in. And then on the supply side of the equation, hotels are very dynamic and experience a lot of wear and tear. And so, you can't have a hotel that today is in pretty decent condition and 3 years from now is in kind of poor condition, right? So it's forever changing and dynamic. So the notion in my mind of a stabilized hotel, there is no such thing. But
So
that being said, go ahead.
let me just take one step back. Sorry. So if we have an apartment building, and we'll make it easy, if it has 200 units in the apartment building, there's usually some specified percentage, 90%, 180 units. If they're leased out, of course, you're going to have people who leave their tenancies, they expire, some tenancies, whatever, there's going to be some deaths, but that's usually considered stabilized. It's now no longer new, and you've got some performance. In my mind, and I guess, I don't have it quite right, but I would think, certain consistent occupancy you feel stabilized is sort of how I was introducing it, and you had, perfectly how you look at it. Okay, go on from there. I just wanted to introduce it to the students.
Okay. I think I covered, maybe Michael wants to add, I'm not sure.
Okay.
I guess there's one other thing that I maybe add here is, because a lot of what we do is for, particularly when we do third party, is for clients who've never been in the hotel business. A lot of what we do is actually serve as moderator, translator, arbiter between the operation and the owner. We use a phrase called owner's prerogative, and ultimately, right, if that's what the owner wants, then we're going to advocate for that. But we also have to educate and inform the owner about different strategies or whatnot to help kind of meet expectations. So, we've dealt with clients who say, just raise the rate, and I don't understand what the problem is. And so we have to explain, or they want to do things that aren't brand approved standards, and we have to explain to them the process in which things can change, or how different revenue management strategies might or might not work. And so we do sometimes find ourselves playing middleman between the operator and the owner, trying to find a immediate middle ground.
Dan, if it deteriorates the relationship between owner and manager, how often is it that you try to terminate a manager, can terminate a manager, or does it just stay a testy relationship? Can you walk us through? We're not talking at the margin. We're talking this is not going well on behalf of the hotel for whatever reason.
Well, I think the first thing that needs to be determined is, why is it not going well?
Sure.
Right? That's really important, right? I think it's fair to say that the great majority of hotels that aren't doing well today,
Sure.
Obviously are, existential issues that nobody has control over. That doesn't mean that prior to 90 days ago, there was no shortage of hotels for New York, for example, that were at the edge of the cliff and about to fall over, and were probably going to fall over. It only got hastened by the pandemic, right? So, in terms of, relationships with operators, I mean, these are contractual relationships, right? And depending upon what the contract says, really determines whether an agreement can be terminated or not. I'm not an attorney. I do believe that case law is such that, sure, you can terminate any operator, right? That doesn't mean that you're not economically liable, right? So, the notion of terminating doesn't mean that you're not responsible to pay liquidated damages that could equate to the present value over the remaining income stream that the operator is expecting, which may be over a 30-year period. So we've recently had, during these past 90 days, the Virgin Hotel in San Francisco, which has been open for a year now, and the owner decided, for whatever reason, I haven't read the complaint, but that, in his mind, Virgin wasn't doing what they needed to do, and he unilaterally terminated the relationship. And I believe the lawsuits, from what I last checked, are flying, all around. So again, it's a contractual relationship. It's not something that's done on a whim. There are lots of business points that get negotiated, particularly performance provisions, right? And
Right.
if the operator is achieving whatever the performance provisions are, and the owner is still not satisfied with whatever, I mean, sure, they can unilaterally throw them out, but they're going to be responsible for liquidated damages, which I don't know where the upside in doing that is. So to answer your question, it's not that easy just to terminate a management agreement, unless you're dealing with an interim operator who's got a 6-month, 12-month agreement that can be cancelable on 30 days notice, which, I mean, there is such a thing. But in terms of, long-term and I would say particularly branded operators, it's kind of tough to get out of those deals.
Michael, when you're thinking about whether to do a third-party manager or owner-operate, how are you thinking about it? And which side do you have a preference, I suppose?
Yeah, I mean, we're a company of 2 people. So when you take on property management, which we actually do, we do manage 1 property ourselves, it requires a whole nother level of infrastructure that, and time, honestly, that is really not our highest and best use. So we rely on third-party management, both for, the infrastructure and also to free us up to be able to, to find other opportunities to acquire and whatnot. So, yeah, I mean, there are those, I did operations for 4 years, but it wasn't what I've done for my entire life. There are those who have done it for their entire life and it's second nature, and they are owner operator. It lets them be more, keep more of the profit to their company, but there's, it requires obviously having all the employees be, employees of you and the company, as well as, just managing all the other variables that are required in operating a day-to-day hotel.
I think it's important to note too that the skill set of day-to-day managing a hotel is entirely different than the skill set of managing investments in hotels. I mean, those are 2 different buckets, if you will. Now, yes, there are individuals and groups that do both, but they very much are, 2 distinct skill sets.
I find especially hotel general managers of luxury properties, to be really quite amazing, skilled, incredibly professional. But when they have those quarterly or monthly meetings with ownership and the asset managers and maybe their own brand, they can get themselves a little bit tense. Seem to be a lot of discussions and questions that will be asked of them. I don't know if that's a question or just a comment. Do you see that, Dan? Does it get tense in those meetings with, a property that's doing okay but not great?
I mean, sure, of course. Everybody wants more and better, right? So, yeah, I would say it gets more tense when you're looking at situations where, and I've been in management meetings where, brand operator basically throwing up their hand saying, we're doing the best we can, which is not an answer, right? But in many cases, that happened to be a unionized hotel in an urban market where the union contract was frankly onerous, and it was really next to impossible for the operator to, and frankly for anybody to make money because of these encumbrances. But that's a whole nother discussion in and of itself.
Sure.
Yeah, I would say that sure, there are definitely tensions in those meetings. If there weren't, then everybody would be happy. And what are the chances of that happening, of everybody being happy?
Yeah, that's not. I'd like to move off this topic and into COVID and go to Dan's slides, but I would like to give you any last thoughts on, well, one is careers that are available for attorneys in this area, the work of developing a hotel. Any thoughts you have before we leave this? Dan, you want to go first?
For attorneys, what are the opportunities? I mean,
Just anything you want to talk about before we leave this topic,
okay.
ranging from careers to whatever you want to talk about.
Okay, but we're talking about attorneys specifically, right?
We are.
Okay. Listen, the hotel sector is a highly specialized sector, and then within the specialized sector, there's a need for specialists who handle different things. And so, there clearly is a whole submarket of counselors, legal counselors, that are focused on either exclusively or a great part of their practice on the lodging sector. And it is a very complicated, dynamic sector with lots of contract law, and between leases for food and beverage and lenders, CMBS, management contracts, license agreements. I mean, there's an awful lot of legal work, litigation from disputes. There's an awful lot of work to be done within the legal arena focused on the lodging space. And if somebody's looking to make a career in hotel law, there's some terrific opportunities. I am very grateful that my skill set, could be applicable to other property types. I only work on hotels. That's all I've ever worked on. And I consider myself very fortunate because when you look at other commercial real estate asset classes, there is something sexy about the hotel industry. There's no question about it. Listen, there are folks out there who own, portfolios of muffler shops, and they make a ton of money. Again, not that sexy, and I'm not putting them down. And by the way, I'm a capitalist through and through. So give me the choice between owning that fancy schmancy hotel where I can tell my friends to come and hang out versus the muffler shops. I'm doing the muffler shops. That's just me personally.
Great. Michael, any thoughts before we head off to look at the current crisis?
I mean, just to reiterate, Dan said, I mean, I think it's an entirely legal world behind hotels, and every decision you make you're always considering the legal ramifications of one thing, whether it's dealing with the brand or the management or the employees or your guests. And, for those who are looking to use law as a starting point to get into the real estate side of the thing, of the business, I think it's a fantastic background to have. My old boss, who's now the CEO of a company called Host Hotels, is a lawyer. Arnie Sorensen's a lawyer. I mean, there's tons of ex-attorneys or recovering attorneys who have made the leap into real estate quite successfully.
Obviously, we're in a crisis. I know you do a lot of work and talk about it, think about it, and study it. Your slides, and where are we and what are you seeing?
So obviously, the world has been turned upside down in the past 90 days, and the title of this presentation, I believe, says it all. It's been a shocking, unprecedented downturn, not just in world economies, but obviously in the lodging space. And we were at peak levels, and within a very short period of time, hit bottom. And if anybody was around in the early 1990s, when the country went through a severe economic recession, at least within the lodging space, there was a term, I believe, that was coined by Sam Zell, stay alive till 95. And so I've decided to sort of resurrect that to stay alive until 2025. So when we look at the metrics for lodging performance, going back to 2008, right, for a good 9-10 years, all the arrows pointed up. And over the last several years, every year we were setting, new metric highs for demand, supply, occupancy, ADR, and RevPAR, which is revenue per available room. Same thing with profitability, setting new records for every year during the past couple of years. And then, of course, COVID came about, and this was as of yesterday, the number of cases in the United States and the number of deaths. It is important to note that these cases are very concentrated in about 6 major urban markets. When this first started, I was clearly getting the sense that there was a lot of, oh my God, the world's about to end feeling. And when I stopped to think back over the course of my life, one of the early memories that I recall is my parents sitting in front of a black and white TV watching the 10 o'clock news and hearing about the Cuban Missile Crisis in 1962, which was an, oh my God, the world's about to end moment. And then as I got older, in the 1970s, there was an oil embargo placed by OPEC that caused severe gasoline shortages here in America and really wreaked havoc on the economy. And it was, again, an, oh my God, the world's about to end moment. Then you go to 1987 and the stock market plunged 500 points, which today looks like nothing, but on a percentage basis, it was 23% of the value of the Dow. And it was another, oh my God, the world is ending. So as we keep going on, right, 9/11, the Great Recession, we've had these, oh my God, the world is ending many times now. And every time we seem to get through. And not only do we seem to get through, invariably we end up at a higher peak than the prior peak. And I think you're probably going to see this again. I really like this table a lot. This is not my table. I borrowed it from my friends at Robert Douglas. They're referenced on the lower right-hand corner. Robert Douglas is a hotel brokerage firm that's involved in the sale of hotel properties and also raising capital, debt, and equity. And what I really like about this slide is that it's very illustrative of where we are and where we're going, right? So where we are at this point is, in the kicking the can down the street phase. In the near term, we're going to get to the come to Jesus phase, survive the winter, and then the new normal. So, and obviously you can look at the bullet points underneath, but very illustrative slide that when you look back over history, this is exactly how this current pandemic is going to unfold vis-a-vis investment cycle in the United States. We know that in the past 90 days, the U.S. economy is I don't believe from a formal definition perspective in recession, but we are in recession and hopefully not getting into depression. The damage that was done to the sector was astonishing. Again, because of the lack of daily leasing, right, and the continuous changing of pricing of rooms. As I said earlier, in an up market, it's a beautiful thing. In a down market, it'll kill you, and that's surely what's happened. This go around. The lights got turned off, right? So it was Arnie Sorensen who came out earlier during this pandemic, along with Chip Rogers. Arnie Sorensen leads Marriott International. Chip Rogers is the CEO of the American Hotel and Lodging Association, basically proclaiming that this outbreak, this pandemic, was worse for the U.S. hotel business than what occurred after 9/11 and the 2008 financial crisis combined, which is really remarkable when you think about it, right? Because both of those events by themselves were fairly enormous. And then the U.S. Travel Association, along with Oxford Econometrics, Economics, came out with an interesting proclamation that this downturn is 9 times greater the impact that occurred in 9/11 for the entire travel sector. So it's been wide, it's been deep, and it's been very swift. And here we can see that going into 2020, which is this year, January and February, these are revenue per available room, or RevPAR changes. January was up, so again, another all-time high, and February was up again, another all-time high. And then we can see what happened starting the week of March 1st through the 7th, where revenue per available room declined 11.6% that week, then 32.5% the next week, 70% the week after, and then it bottomed out at 80, which is where it kind of bounced around for a period of time. But think about that for a second. Revenue per available room declining 80%, 80. It's mind-boggling. It's never happened before. You know, when you make an investment in anything, you plan for, you know, downside risk. Downside risk doesn't mean that you lose 80% of your revenue. Because if that's what you're planning for, you're not making an investment to begin with. And then this table shows that it's really the same statistics, but what it's showing is that looking at Atlanta in the upper left-hand corner, that over the past 5 weeks, Atlanta seems to be coming out of this dramatic downdraft a bit quicker than in the lower right-hand corner, Oahu in Hawaii, which is, you know, been hovering around 90+% loss of revenue per available room for weeks and weeks now. Smith, these are STR forecasts. Again, they really are quite astonishing. Actual occupancy and ADR compared with 2020 forecast. I mean, for the year, it's being forecasted that the nation's going to do 36% occupancy. That's mind-boggling. And then jumping back up to 52 in 2001. And I think one of the important distinctions of this slide in the lower right-hand corner, where it shows revenue per available room, 2020 forecast is showing for the nation a decline of almost 58% this year, and then a rebound next year of an increase of 48%. And the point being that particularly folks that are not tuned into the hotel space on a full-time basis, many of them tend to not be able to comprehend the notion that the value of a hotel can change dramatically very swiftly, right? So the fact that the notion that a hotel value can go up 20, 30, 40% in a year is just the same that it can go down 20, 30, 40%, go down 20, 30, 40% in a year. And most other forms of commercial real estate, that doesn't happen as dramatically because they have long-term tenancies, many of which are creditworthy. So, you know, these numbers show it all, right? You lose 58% one year and then gain back 48%. It makes sense that value would bounce around quite dramatically as well. Some of the interim uses that we've seen occurring, you know, in the sector since the pandemic took hold, you know, empty hotels being used to quarantine folks that need it, emergency housing for first responders. In the upper right-hand corner, Ty Warner, who owns the Four Seasons on 57th Street in Manhattan, was one of the very first ones to step up and make available his property for medical workers and for no charge. Another interesting one is on the upper left-hand corner, Citadel Securities, who's at Ken Griffin, moved his operations down to Palm Beach and took over the Four Seasons and literally opened up a trading floor down there. So sort of interesting alternative uses. Liquidity, you know, during a time like this, it's all about, you know, being able to hang on and have the cash to hang on. And so, you know, all the big boys have drawn down on prior credit lines and established new credit lines and doing what they need to do to have cash available to hold on for however long this is going to last. And, you know, it looks like preliminarily we're coming out of it. We don't know yet about secondary and tertiary infections, but the point being that, you know, liquidity is absolutely the lifeblood to staying alive. And there's also no doubt that these days cash is preeminently king. And, you know, interesting to note how some of the hotel companies like Marriott and Hilton are doing some unique and different things to, you know, to raise cash, which is really what's imminently needed. And, you know, it looks like they've all done a really good job at it. You know, clearly the world is braced for a dramatic rise in loan defaults and delinquencies, you know, particularly in the CMBS arena, which is, you know, interesting in that I think it's safe to say that if at this point there is any hotel in America with CMBS debt on it that's not in default yet, probably will be by the end of next month. And it's going to be a real challenge because CMBS, unlike balance sheet lending, there's nobody to talk to. There's nobody to work the situation out with except what's called special servicers, and that's a whole another discussion in and of itself, and their hands are tied. So yeah, there's these looming maturities and defaults are going to have to be reckoned with, and it's going to be a real challenge. Litigation always goes on, but we're seeing a fair amount of it bubble up even more now that you know, things are a little bit tough. I think I mentioned earlier on this call about the Virgin San Francisco suit. Another one I find very interesting is the one on the upper left, Anbang, which is now known as Dajia or something to that effect. Essentially, the Chinese government has recently sued Mirai, which is a South Korean investment firm that was in contract to purchase the strategic hotel portfolio for $5.8 billion. They have not closed Mirai, and they've indicated that they won't close, and so Anbang is suing for specific performance, and it's going to be very interesting to see how that all ends up. Lots of investors out there that have already swooped in to take advantage of the dislocation, and we're talking about smart, sophisticated investors like Blackstone and Starwood, investing in Extended Stay America, or Lone Star buying a Japanese hotel firm, or Carnival Cruise Line really being up against the wall, and the Saudi sovereign wealth fund investing 8% or buying an 8% stake in Carnival Cruise Lines. Airbnb, we've heard about 2 rounds of $1 billion each that they've gone after. It's been very expensive money for them, but again, liquidity is what they need to survive. And then the last picture on this slide that I'd like to talk about is the Ritz in London, which is, I believe, a 113-year-old property that has been operational every day of its life until the very recent past. On the day that the transaction closed, where the property was purchased by Qatar, the day that the transaction closed, the hotel closed for operation for the first time in its history because of the pandemic. I thought that was a little bit interesting.
Including World War II?
It was open, never closed. Wow. Never closed.
Okay.
The $1 million question today, you know, everybody's asking about, you know, where are market values, and you know, early on in this pandemic, you know, I was hearing people say, you know, anywhere between 5 and 50%, 50%, which is a nice wide range, right? You know, the reality is, if you look at the fundamental premise of market value, and there's a definition underneath, there are different definitions out there, but for all intents and purposes, excuse me, the basic premise is willing buyer, willing seller, neither under duress. And you know, the fact is that today there really is no market, if you think about it. I was on a call with a handful of CFOs, a couple from public entities and a couple from some private platforms, and they brought up this topic and said that theoretically, since there's no willing seller out there, anybody who has to put a property on the market today is not a willing seller. That's a more of a liquidation scenario, and they were saying, you know, if there's no willing buyer and no seller, and there's no willing seller, there's no market. Theoretically, one could argue there's no value, which is kind of ridiculous. There is value. The point being that you need to look over a long-term horizon, right? If you're looking at value today, literally May 22nd, 2020, where, you know, somebody has to sell an asset, it's invariably going to be, you know, a stressed situation and a liquidation value, which is probably going to be based upon an all equity return, without the ability to leverage off of lower cost debt and bring down the overall cost of capital. And until we start seeing trades occur, actual trades, it's really a guessing game as to where values are, whether it be 5 or 50% down.
Michael,
it's also going to depend on the specific asset and the market that it operates in.
I'm sorry, Michael, are you in the market? Are you looking for properties in in this pandemic?
We are. We actually submitted one LOI already. We got another one going out shortly. And to Dan's point, the first one would be an all-cash transaction. And the second one, we'd be able to step into the debt, so we wouldn't have to go out to the market to get a loan. But yeah, I mean, we are active. We continue to look for deals. We have no expectation that the seller will agree to our price, even if it's a fair price. I think every seller assumes we're lowballing, or every buyer is lowballing. But we want to make sure that sellers know that we are ready to move if and when the time comes.
Michael, I'm curious, those two transactions, if you were looking at them pre-COVID, what would be your best guesstimate as to what has been the erosion in value today versus pre-COVID?
Well, one asset, the seller has cut its price guidance because we talked to them pre-COVID, and they've cut their purchase price guidance by 30%. We are still below that, so it's probably 40% right now. And
Great.
It's just, you know, I think to your point and everyone's point is it's so hard to predict what the next 12 months are going to be that we have to take a really conservative approach. And so it's really, you know, we're not assuming any kind of, we're not getting to ADR levels for 2 to 3 years and NOI levels for 3 to 4 years. It's just hard to apply any, you know, pre-19 values anywhere close to what, you know, the seller wants.
Well, I'm glad that your numbers there work within my 5 to 50% range. Steve, you want me to go on?
Yeah, sure, please.
Okay, so I'll try to move faster. This is an interesting slide in that it talks about a PE firm that's focused on commercial real estate, not hotels though, multifamily and retail. But these couple of guys, they have $50+ million of their own personal net worth invested pari passu with their investors, and they put out a letter that somehow is in the public domain. They put out a letter to their investors back on March 6th, where if you look at what they wrote, they literally wrote, "We don't know," which I resonate with that type of approach, right? If you don't know, just say, and I've been saying, I don't know, this is what I'm hearing, right? I do get amused when shortly after situations like this, all of a sudden, you know, people come out and pontificate that, you know, values are down. I remember hearing after 9/11 that, you know, somebody saying values were down, whatever, 30 to 40% on 48 hours later. I don't know how you know that, right? And the same thing with, you know, there were reports coming out that this is going to be a 5-year horizon before we get back to, you know, pre-COVID, which may be right, okay, but I don't know how you know that a week into it. In any event, this sort of validates my theory that nobody knows, and if anybody does say they know, they're making it up as they go along. This is an interesting data point that you can look to. Back in 2001, I actually worked on this transaction. In August of 2001, Blackstone signed the purchase and sale agreement to buy Homestead Village Suites for $900 million. 9/11 happened, the deal cratered, and then it was resurrected and ultimately closed in November, December for a reduction of $160 million, which equates to about an 18% decline. So it's a data point. It's not something I'd hang my hat on, but you know, just something sort of interesting to look at. I talked a little bit earlier about CMBS. Very interesting. Ethan Penner, who runs a firm today called Mosaic Real Estate Investors, he's credited with being the father of CMBS. He created the structure in the early to mid 90s when there was no financing available for commercial real estate. And he saw a niche, and with Nomura, developed the CMBS concept, and for a period of time, it really was the only financing that was available for commercial real estate. He built an amazing platform, made a ton of money doing this, but he recently came out and opined that the structure that was developed back in 92, 93, 94 was built for the time. In the time, it was not built for the way the world operates today, and sort of validating that CMBS structures, if they're going to exist after this pandemic is over, they're going to need to have a significant major overhaul, because it's sort of like Warren Buffett when he said that you only know who's sleeping, you only know who's swimming naked when the water goes out, when the tide goes out, right? So during good times, sure, CMBS is great. It's quick, it's cheap, it's it's supposedly non-recourse, right? But the tide has gone out, and now we see all the challenges and issues with CMBS. Where we're at now, clearly sponsors and managers are on the defensive position, bolstering liquidity, mitigating cash burns. Private markets are flush with capital to take advantage of the situation. The brands have been playing very nicely in the sandbox up until now, offering significant fee relief to franchised hotels. And then on the right-hand side, we can see two workouts that have already been done, the terms of which are in the public domain. Just to get an idea of of what's going on out there in terms of forbearance, which for the most part, 60 to 90 days, if you get that, and it starts with your first day of missed payment, so assuming that's April 1st, that takes you to July 31st, which is 35 days from today. I don't know what that really does for you, but that's the kicking the can down the street. The road back, looking to China, not looking to necessarily China's driven statistics like Shanghai Disneyland reopening, but rather American companies that are operating hotels over there. I'd like to think that those statistics we can rely upon, and all the big brand families are saying that things are turning around and looking optimistic. Here in the United States, I think Americans just generally are an optimistic bunch, love to travel. And, it's every American's God-given right to go on vacation, whether they can afford it or not. And so that's a good thing. Yogi Berra once said, it ain't over till it's over. And it happens to be true in this case. We clearly, it does seem to be, we're on the backside of this pandemic. But when you look at this map, which was gleaned from just a couple of days, maybe 10 days ago, there are parts of this country where the outbreak is growing, not declining. Obviously, there are more areas where it's declining, but there are areas where it's growing. And so it's not over yet. We also don't know about possible secondary and tertiary waves. I have a slide later on where there's a part of China that today, the northeast part of China, literally there are 100 million people that are now on a secondary lockdown. It's a pretty scary thought when you think about it. In terms of the road back and what it's going to look like, we've seen this movie before in other downturns, right? International travel, it's going to be a while before they come back, and then domestically, the drive-to leisure, we hear this day in and day out. It's very logical. They're going to be the first ones to benefit drive-to leisure type markets and assets, resorts. Next, business travelers, and that's really going to be all about confidence building. Right. I'm not confident in getting on an airplane right now. And then, of course, group meeting and convention is going to be the last one. It's going to probably take a long time. And that also is very much, tied in with confidence building. We are going to get back there. The question is when and how long it's going to take. Some of the challenges to getting back to pre-COVID. I mean, let's face it, the airlines are in a really tough spot right now, and the lodging industry is very dependent on other intermediaries that they have no control over. The airlines being a big one, right? So if the airlines aren't flying, it gets tough to put heads in beds. So that clearly is a stress, for the sector. More challenges. We've been in a period of time where between unemployment and federal benefits, from an economic perspective, it's been more beneficial for many folks to just sit at home and collect unemployment and the federal benefit, because they end up making more money than if they went back to work, right? So this obviously wasn't thought 100% through, and so it creates a challenge for bringing employees back. But furthermore, employees are scared, right? Just like everybody else is scared, and they have hesitation about going back. So that's clearly going to be a challenge for the sector as well. Never let a crisis go to waste. I'm always amused webinars that I listen to, and they talk about how the new cleaning standards and what have you, and I'm going to talk a little bit about that. But always with the preface that, well, the lodging industry, we've always had very clean facilities, but now we're going to have even uber clean. That's really not true. If you look at these headlines, which go back 5 years or so, the hotel industry has been dealing with for quite some time sanitation and bed bugs and cleanliness and what have you. But I think it's safe to say at this point, with the new normal, and the U.S. Travel Association has come out with a guide that talks about travel in general in the new normal, which encompasses not just hotels, but airlines, rental cars, trains, et cetera, et cetera. And then the American Hotel and Lodging Association, who's the trade group that represents the sector in Washington, D.C., convened a advisory council of, lots of the big boys, to come up with a high level of enhanced industry-wide cleaning standards for the lodging sector. It's called Stay Safe. And, I also wanted this picture of Chip Rogers up here. Chip is the president and CEO of the AHLA. And in my humble opinion, I really believe that Chip and his colleagues at the AHLA during these past 90 days have done a remarkable job at representing the sector in Washington. And thank goodness for them is really all I can say. I do find it interesting how, once the AHLA and the big boys in the sector got together and came up with those high-level enhancement guidelines, then each brand family kind of went out and then attempted to drill down even further and then sort of create their own brand of cleanliness, right? Hilton Clean Stay with Lysol, Choice Commitment to Clean, Best Western, We Care Clean. I don't know. I'm not so sure that this was all necessary. I don't know why you have to differentiate yourself on cleanliness, particularly after what we've gone through, and that the AHLA already was coming up with with sort of standard operating procedures. I don't know why the sector had to go and then segment even further and promote their own cleanliness platforms, but. In any event, the new paradigm for travel, well, clearly no handshaking. I personally was a germaphobe way before Donald Trump was ever a germaphobe, and never liked shaking anybody's hand. And I'm so glad that I won't have to anymore and not be perceived as being rude. So when I see you guys next time, it's going to be the elbow.
Yeah, we'll just bow to you.
There you go. Anyway, here are a couple of things that, on way traveling, is going to look different going forward, from, setup of airline seats with plexiglass around them and, thermal scans and, wearing masks on airplanes, paradigms within the actual operation of hotels that's going to shift, keyless, touchless, contactless, whatever word you want to use. That's kind of the name of the game. It's kind of interesting being able to use your mobile phone to access rooms. A lot of this technology has been around for a while now, and a lot of the the brand families have only reserved that for their elite frequent travelers. At this point, it's going to be a level playing field. Everybody's going to get it. Nobody's going to touch a key again. Hilton's got a program where after the room gets sanitized, they can literally put a seal on it, and you personally are going to cut the seal to go into the room. Much more use of biometrics, think about Clear when you go to the airport and the biometrics that are used there. That same platform is easily adaptable into the lodging sector, and I think you're going to see it. Also getting used to, service providers, waiters, waitresses, bartenders, and the like, having masks on, the use of robots. A loft robot has been around for a couple of years now. I think now you're really going to see it being rolled out all over the place. In terms of capital, there is an abundant amount there was an abundant amount of capital pre-COVID, and there's been a whole lot more that's been raised in the past 90 days. Again, this is smart, sophisticated money with pretty good track records, a la Barry Sternlicht, Blackstone, Thayer Ventures, Apollo, all, waiting to pounce. And there's a tidal wave coming in. There's no question about that. What does the future look like? The world is clearly, being challenged with, in addition to the pandemic, all sorts of geopolitical stresses. I mentioned a couple of minutes ago that there were, no shortage of hotels, particularly in some major urban markets like New York, that, were over-levered and already stressed pre-COVID. It's probably going to be lights out for a lot of these hotels, and they probably will never reopen as hotels. This is where you get to the alternative uses, right? And then, I'd like to think that at this point, brand proliferation is going to be placed on pause, and hopefully for a long time, because I humbly believe there's way too many brands out there, and the world does not need any more hotel brands, and that the near term, 24 to 36 months, will not be an opportune time to roll out new brands.
Dan? Hey, Dan?
Yes.
Just a quick story. Last week, we got a letter from one of the brands about a new hotel development in one of our markets. And did we want to write an objection letter or not?
Let me think about that. Wow, that's pretty amazing.
Yeah, the scary part is I still don't know if they'll listen to our objection.
Well, you know the answer to that. You know the answer to that, right?
Yeah.
You really, for whatever it's worth, and we can talk about this offline, we've worked on a number of true impact analyses that were prepared in advance of potential litigation, as opposed to an impact analysis that a brand hires a consultant to do that gets stuffed into a file. I think you know the difference.
Yeah.
Let's move on here. So what are we going to see in the near term? I mentioned earlier, hotels that will never reopen as hotels. A very prominent asset in Boston, the Hotel Buckminster, 1,000% location on Kendall Square, closed during the past couple of weeks, and it's permanently closed. It's an amazing location. The Hotel Pennsylvania in New York, there's word that will finally not reopen as a hotel, and the property will be redeveloped as something else. It's something that's been considered on and off several times during the past 20 years, and it looks like it may actually happen this time. And then in the lower left-hand corner, jingle mail. That was a big term in the 90s, which essentially was the sound that comes out of a envelope that has keys to the entrance of a hotel in it that go back to a lender. Word on the street is we're going to be hearing a lot of jingle mail coming through the sector pretty soon. What else are we looking at? In the near term, I mentioned earlier about secondary wave and the 100 million population in China's northeast that are under another lockdown. I mean, that could happen here, and if it does, that obviously is a real challenge for the sector. Property tax disputes. I think it's fair to say that every hotel in America is going to file for a property tax dispute reconsideration. Maybe that's good news. The bad news is that every municipality's budget is blown out the window, so that sure, you want to get your assessment reduced, no problem. We'll reduce yours and everybody else's, and we'll just raise the tax rate so that effectively your tax burden is going to be the same or more than it was previously. But in any event, Airbnb, everybody talks about Airbnb and what's going to happen with them, in terms of, are they going to continue to invade into the hotel space? Well, obviously we know that at this juncture, their value has been slashed in half. They were getting ready to do an IPO and instead had to go out and get 2 rounds of funding, $1 billion each, that they paid very dearly for. The fat lady really hasn't sung yet as to, what's going to happen with Airbnb. I firmly believe that the traveling public, at least initially, and for quite some time, is going to be feeling much more comfortable with standardized, branded lodging accommodations as opposed to independent hotel accommodations and or Airbnb type of travel, for the mere perception of sanitation being standardized and guaranteed, if you will, with a brand, as opposed to with Airbnb, you don't know what it is. And you could argue that with an independent hotel, you don't know what it is. So I think it's going to be a real challenge. I have thought for a long time, I'm talking about years, that, Airbnb married up with a brand family, might be a compelling story, obviously very much dictated upon economics. But now that the value of the Airbnb has been slashed in half, the chances of that happening might actually be better now than it was a couple of years back. Now, I base this on nothing but merely my gut from 40 years of doing what I do. If it happens, remember you heard it here first. If it doesn't happen, forget I ever said it. It's interesting when you look at sort of the outlook in the world. These are smart, sophisticated, very successful folks, right? Sam Zell and Warren Buffett. But they have a little bit of a, glasses half full outlook on the world, right? All these headlines are from May, just the past 3-4 weeks, right? These headlines are also from the past 3-4 weeks. And, they can prompt somebody to say, well, the glass is, excuse me, the other one was half empty. This is half full, right? So, life is really relative and it depends on how you want to look at it. We are where we are, and you can argue that the glass is half full or that it's half empty today. It all depends on what your orientation is. I'm about to wrap up here. I find this very inspirational. This gentleman, Tony Vaccaro, his mother died at childbirth. His father died from tuberculosis. He was an orphan at age 5. He endured beatings from relatives in his home country of Italy. He ended up emigrating to America, serving as a GI during World War II, survived the Battle of Normandy. I actually Googled to make sure this is all true, and he ended up becoming a celebrated wartime and celebrity photographer. And he's at 97 years old, and he fully recovered from a bout of COVID. And I like his attribution to longevity, blind luck, red wine, and determination. So I found that very inspirational. And then I was even more inspired by this lady, a 107-year-old woman who survived not only the 1918 pandemic, but survived COVID-19. So my last slide is this saying, in all things, it is better to hope than to despair. And that, I hope that everybody at this point is choosing the hope and not the despair. And that's my story. I'm going to stick to it.
Can you hit the stop share button?
Let me do that.
Because I want to thank you. No, there should be a red button towards the top that says stop share.
If
you don't see it, there we go.
How's that?
Perfect. Dan and Michael, thank you so much. Michael, always, whatever I ask you, drop things and come to College Park, to DC. Dan, you were there at the very beginning, driving down from New York. It's been a great pleasure to follow all that you do and all that you guys give. I'm going to give you both the last word. Michael, you can have the first last word, then Dan. Any thoughts for the students as they head out?
Yeah, I mean, I think with chaos comes opportunity, both from a career and an investment and everything else. So, it's hard to see past the next day or week, but I think there's going to be a lot of exciting things that are going to come out of this, whether it's, reworking all the CMBS contracts in the world or everything else. But I think there's going to be a lot of interesting opportunities in the next 12 months.
And happy as can be, you went from RLJ to Woodmont Lodging and off you go.
Yeah, wouldn't second guess that choice.
Dan, you were in Lausanne, you were at F&B, now you've been top of the world for a long time. Any thoughts for the students?
Yes, never forget that the world is not going to end. And as illustrated by one of my early slides, right, when you look back over the past, 60 some odd years, I illustrated 6 different events that were, oh my God, the world is ending type of events, and the world hasn't ended. So my advice would be hold your head up high, recognize that life is far from perfect. 2 steps forward, 1 back is still a step forward, right? And if you make a mistake, if you fall down, okay, that's fine. You get up, you dust yourself off, and you keep going. It's the American way. And there's so much opportunity, and it really, we're all blessed to be here, in a true democratic society, and be able to take advantage of variations in the market. And we're now at a point in market cycles where there will absolutely be tremendous opportunity and a lot of money to be made.
Thank you guys so much. Be well, and see you in person in 2021. Thanks.
All right.
Thank you.
Thank you.